So here's the deal. Silicon Valley Bank, founded 40 years ago. It's exactly as it sounds. It was a bank that encouraged the venture capital community of Northern California to do their banking there in order to have access to, the benefits that startups could, enjoy, low fees on startup accounts and things like that. Mm-hmm. And it was a bank that had, over that 40-year time period, actually grown fairly responsibly. If you take a look at where Silicon Valley Bank stood at the end of 2019, they had about $62 billion in customer deposits that had accumulated over a 35-year period.
Which probably puts them at the end of 2019 in largest 50 banks?
Yeah, they're a top 50 bank by deposits
at the
in
end
the United States at the end of 2019. What happened, though, is remember all of the hype and all of the craziness in 2020 and 2021 with the money printing press. A whole bunch of money comes out into the financial system, and where does a lot of it go? Straight into everything VC, specifically, crypto and Web this and Web 3 that and yada yada.
I mean, that was the big joke of 2020 and 2021 was everybody was suddenly a angel investor.
Yeah, exactly.
Everyone out there was trying to make investments and loans to new startups.
So Silicon Valley Bank, which had grown to $61.76 billion in customer deposits by the end of 2019, that's according to their SEC filings. That's where we're getting this info from. By the end of 2022, just 3 years later, they had $173 billion in customer deposits. The size of them almost tripled. Okay,
that suddenly made them top 20 bank.
They're now a top 20 bank by deposits in the United States. And here's the thing. In the 5 years before that tripling of size, Silicon Valley Bank was growing their book of business by about $4 billion a year. That's what they felt they could, comfortably grow at. All of a sudden, they went, and in 3 years, they grew by an average of about $40 billion a year, 10 times the speed.
Okay. In and of itself, if I didn't know anything about how banks work, I would just say, okay, so you open some new branches, you hire some new people, and you accept the deposits. What's the big deal? I think understanding the underpinning of how banks actually fundamentally operate is important here when getting into SVB.
Let's say that I want to start the Bank of Chuck, which today probably not something I'm considering.
I think you might have a tough time attracting investors.
Might be tough to attract capital. So let's say that I just take $5 and I say, hey, I'm going to start the Bank of Chuck.
Okay.
Mike says, hey, you know what? I'm going to put $1 in. And Tucker says, I'm going to put $1 in. And all of a sudden,
you know what? I'll put $2 in.
Boom, there you go. I got $100 in deposits over time. Well, I got to attract those deposits somehow, so I'm paying out interest on them. I'm paying you guys 0.5% a year, okay? And you guys are happy for that because you say, fine, Chuck's a great guy, blah, blah, blah. I got to make money, though, somehow. I can't just pay you out in perpetuity because I'm losing money then.
Took the cash and sat on it, then it's not going to do much for me.
What's my bank going to do? Nothing for me. So what do? I go out and I start making loans with your money. And so what I end up with is a situation where I've got $100 in deposits and $100 in loans that I've made. That number basically has to match up from one side to the other. It's why they call it a balance sheet, is my assets have to equal my liabilities. Otherwise, I get into trouble. What happened in the case of Silicon Valley Bank and what would happen in my bank is, let's say that I issued those loans at low interest rates and then interest rates went up, okay? The value of the loans on my books, they are now lower because if I can go out and buy a $100 loan at 6% and get paid $6 a year instead of a $100 loan at 3%, why would anyone buy my loan at 3%? They wouldn't. And so that loan is worth less. Where Silicon Valley Bank got
important distinction. It's not worthless. It is worth less than it was.
Yes.
Important distinction when we get into the comparisons to today compared to 08.
And here's the other piece. Eventually, as long as that loan is paid back, it will eventually get back to being worth what I issued it for, okay, when it's redeemed finally and when it matures.
29 and a half years from now or whenever it is.
But it's a long road to get there. So what banks do and what they have the ability to do is they can move loans to what they call the hold to maturity side of their balance sheet, which means that instead of having to value that loan today at what it's worth on the open market, instead they can amortize it over the course of the loan because they say, hey, this loan is not worthless today, but not even worth. This loan is not worth 70 cents on the dollar today, as an example. It's worth 98 cents because I'm not going to realize the loss right now. I'm going to do it over time.
Yeah.
Where Silicon Valley Bank got into trouble, because they grew so quickly, they basically bought a ton of mortgage debt in 2021 and 2022. Well, in those 2 years, we had the lowest mortgage rates in the history of the country. So they were buying all this debt at the lowest rates possible that it was issued at.
If you made a bond investment in 2021 and saw what it did in 2022, you've basically experienced what Silicon Valley Bank experienced over the last year.
So what they did is they moved a whole bunch of this into their hold to maturity bucket so they didn't have to have those losses show up on their balance sheet right away. And where they got into trouble last week was they basically said, look, we're going to take like $20 billion of this, and we want to sell it because we need some capital. And then we're also going to do a capital raise just to recapitalize ourselves. And instead of VC firms, which have boatload of money, by the way, okay, tons of cash still sloshing around, not as much as there used to be, instead of them saying, yep, you've been a great bank for us for the last 40 years and we really want to help support you, the VCs all got on their phones together and, different chat groups and this and that, and they said, man, there's a problem here, let's pull all of our money. And so what you ended up with was a single-day request for $42 billion in withdrawals from Silicon Valley Bank, where they had $172 billion in deposits. It's a quarter of their funds asking to be withdrawn in a day. There is no bank in the United States that would be solvent in those conditions. There's none.
As a percentage.
As a percentage. There's no bank that can have a quarter of its deposits redeemed in a single day.
And survive.
And be able to, just issue them out of its own funds. It's just not how the banking sector works. So, in terms of where we ended up then, they obviously couldn't pay out all of those depositors, so they go into FDIC receivership. And then over the weekend, we get to, okay, how are we going to make this work? What the Fed and the Treasury have effectively decided, along with the FDIC, is that any of the depositors who had money at Silicon Valley Bank, they're being made whole 100%.
Yep.
Now, you might say, oh, geez, those greedy venture capitalists, they're getting all their money back. Fact is, if this were Farmers Bank of Kentucky or whatever, and you had, quote, small businesses there that still had more than the FDIC minimum of $250 because they needed to make payroll in there, I think you'd probably feel differently. The reason why you back depositors 100%, no matter what, and again, this happened, even go back to the financial crisis, is because if you don't know that your money is safe in a bank, then you are not going to have a banking sector.
Yeah, so there is plenty of criticism to go around here in terms of risk management and decisions that were made. But if I'm just focusing right now on the decision by Treasury, Fed Reserve, and FDIC to back all deposits, I don't think they did it because they are in bed with venture capital firms and are looking for that next gig. I really think that this comes down to the domino effect. If you had not backed deposits, then businesses and individuals across the country today would be looking at their bank accounts, looking where they're held, and saying, if I have deposits over $250, I'm moving them elsewhere.
Because there are 4 banks in the country that we know your deposits are backed 100%, even if you're over the FDIC limit.
Because the bank is too big to fail.
The banks are too big to fail.
Yep.
Bank of America, Citi, Wells Fargo, and who's the fourth that I'm messing? JP Morgan. Okay. It's already been proven that those banks are too big to fail. So if you didn't back the smaller regional bank in this case, then immediately today you end up with a run on every regional bank because why would I keep my money there if you're not going to back it 100% there, but you would at Bank of America or Citi?
That seems to be the decision that was made was we do not want a banking system in the United States that is for banks. We want regional banks. They serve a purpose, and without this action, again, you can't dictate or tell what would have happened in the absence of action. We're playing a guessing game here, but I am quite confident that in the absence of what the Fed, Treasury, and FDIC did over the weekend, you would have many more banks being closed by FDIC this morning. You still probably and very well may
There
have
still may be another
ones.
2 or 3.
But without the action, there likely would have been a whole slew of them within hours this morning.
Now, who's not making out well in this? Equity holders of Silicon Valley Bank. They are not getting bailed out at all. In fact, their stock doesn't even exist anymore. It is worth zero. If you want to know how little Silicon Valley Bank stock is worth, it's not even trading anymore. But the UK arm of their business, which had $6 billion in deposits, that 2 years ago was probably worth $1 billion to $1.25 billion just on its own, just got sold to HSBC for £1. I'm going to say that again.
That's a line in the sand.
Okay. The people who actually ran the bank, getting a big fat zero. There were a whole bunch of executive cash outs in the last 3 months. They're all going to get clawed back.